The key advice that I would give to business owners where their business is growing in regards to CGT would just to be engaged with your tax agent and discuss what you're thinking, even if it's 2 to 3 to 4 years ahead, because you can put plans in place which will allow you to access concessions in the future that if you didn't attend to those now, you may not qualify for. My name's Glenn Harris. I'm a director at Bishop Collins Chartered Accountants. I've been with the firm about 11 years now, and I've got about 35 years experience in the industry, supporting clients with predominantly their tax affairs and business structuring. I enjoy helping clients with that because they're often very strong in their own specialty in regards to their business, but they get quite lost in navigating the challenges of the business structure, compliance associated with that, and also more mature businesses that are looking to sell, supporting them with an exit strategy to ensure that they keep the maximum amount of value personally, for themselves, for their children, for the years ahead, for their retirement. Well, any taxpayer will likely be up for capital gains tax where they've held investment style asset and sell it at a profit. How would I describe people who are exposed to capital gains tax? Well, they fit in a couple of categories. So what we predominantly see in our business is mum and dad investors. So they might have an investment property or a share portfolio. They will then look to sell that and be interested to know what the capital gains tax on that will be, just so they can plan ahead as to what they will have left once they sell an asset, repay a mortgage, and then is that enough for their retirement or whatever else they would like to do for the cash. We then have more sophisticated investors, so maybe business operators, even people with a self-managed super fund who are doing their own investment strategy through that. And often there's more complex issues connected with those transactions. So capital gains tax won't apply to your motor vehicles or to your family home. Generally, they're exempt from capital gains tax. But anything like a share or an interest in a company or an investment property will certainly be subject to capital gains tax. What is capital gains tax? Well, it's really tax on the profit of the sale of assets that is different to ordinary income like your salary or business income. It came in 1985, so any assets acquired prior to that date are generally exempt from capital gains tax. Any assets acquired after that date, if you sell it for a profit, generally that profit will go into your taxable income. It's quite a complex tax. There's a lot of exemptions and also concessions in regards to that. So whenever you're looking to sell an asset, my recommendation is that you really seek advice from a tax advisor to make sure that you've set yourself up prior to the sale or entering the contract to make sure you can access those concessions and give yourself the best chance to reduce any tax payable on that sale of that asset. Yeah, there can be. So broadly, they're treated the same. The rules are similar. Often with a property, if it's connected with your business, you may be able to access what's called the capital gains tax small business concessions. Now, they're very generous. They allow you to sell an asset with significant discounts, and often if that's in connection with retirement, so if you have a property, it's used for your business, you're retiring, you can make quite a significant reduction, if not eliminate capital gains tax. Shares are relatively straightforward. If they're just shares that they're passive investments, you'll pay capital gains tax on any profit, which is really just the price you sell the share for compared to what you purchased it for. There is also what's in Australia known as the general CGT discount. So what that means is if you sell an asset and you've held it for more than 12 months, you only pay tax on half the profit. So the key concessions and exemptions in regards to capital gains tax relating to property sales, there's quite a few options there. Where the asset's passive, you'll generally be entitled to a 50% capital gains tax discount on the amount of tax you pay. In addition to that, if it's what's called an active asset or an asset connection with your business operation, there's some quite generous discounts under the CGT small business concessions. So they allow you to reduce the capital gains tax significantly, if not eliminate it totally if the sale is in connection with your retirement or a similar event. If you're a business owner, and you're looking to sell your business or property connected with your business, it's really important that you consider the timing of a transaction. There's a lot of concessions there that are available to you, and if you qualify for those concessions, You can significantly reduce your capital gains tax either on the sale of the business or the sale of an asset, like a property connected with that business. That may be, a warehouse or a factory or something similar, even an office space. And if you get the timing right and you qualify for those exemptions, ultimately you can reduce your tax liability to nil. But it's important that you plan that transaction to make sure you qualify for those concessions. So there may be actions needed before you enter into a sales contract for the business or the property, that you tidy your house first to make sure you qualify for those exemptions. So if you're considering selling your business or real estate connected with your business or another asset connected with your business that may be subject to capital gains, it's really important that you speak to a tax advisor in advance of entering any transaction. Because what you want to do is make sure that you've set up the structure correctly to qualify for the really generous small business CGT concessions, because that will allow you to really minimise the amount of tax that you pay on that transaction, and will make a fundamental difference to the amount you keep in your pocket after the end of the transaction. Yeah, look, at Bishop Collins, the You're Not Alone in Business statement, we take that really seriously. That's important to us because the way we look at it is it's a partnership, and we want to support you to be successful. If you're successful, we're successful. It is a real partnership that we work together to support each other to get that best outcome. Please reach out to Bishop Collins for support, because you're not alone in business.